To sum it up, Japan maintained a near zero and even negative interest rate policy for over 2 decades to deal with a deflationary spiral. In the late 1980s, Japan experienced one of the largest bubbles in modern history, and then that bubble popped. And so, once that bubble popped, for decades, Japan was dealing with deflation and zero growth. Prices didn't rise, wages didn't rise, people were delaying their spending, and companies hoarded cash. So, in an emergency reaction, Japan made drastic policy moves. They slashed interest rates down to zero and even took them into negative territory. They borrowed money to spend on infrastructure and made massive purchases of Japanese government bonds under a yield curve control program. The goal with the yield curve control program was to stimulate economic growth by pinning short term interest rates at negative 0.1% and 10-year government bonds at around 0% by purchasing bonds. Keep rates low, people can borrow, and then they can go out and spend and invest in the economy, hopefully bringing them out of that deflationary spiral. Now, after 30 years, Japan finally got the thing that it had been looking for, which was sustained inflation with rising wages. So the emergency was over, and the Bank of Japan ended its emergency programs.